So in part 2 of this module, we're going to discuss why even get into real estate. Again, I've mentioned this before. Real estate is a working asset. Unlike a stock or a CD, which you purchase and someone else manages for you, real estate is an active entity. So you're actually involved in your real estate assets. You may have a property management company, but you're still somewhat involved in it because you're managing your property manager again. So it is a working asset. So the question is, why even get into real estate? I'm going to discuss the specific reasons why there are clear advantages to getting into real estate versus getting into the stock market. But there are certain things that you need to understand before you get into real estate again. I think historically people have developed a lot of wealth in real estate, and that's why there's so much interest in it. The propagation of folks like Donald Trump, Flip This House, all these shows, they always showcase real estate, and they showcase how folks have made wealth, passed wealth down to their loved ones, and a lot of it has been from real estate portfolios. So I think there's a historical, kind of a natural affiliation to real estate. Hence the reason every time I introduce myself, I make it a point and I embellish the fact that I am a residential property manager that manages other people's real estate. I always get that piqued interest from people saying, oh wow, I've always wanted to get into that. So real estate definitely has an attraction to it. What I want to get into this part is to what the technical reasons to get into real estate are. Again, not the emotional reasons, but the technical reasons. The first one is cash flow. Real estate offers cash flow like no other investment product does. And just to give you a definition of what cash flow is the flow of cash from the left-hand side, which is your rents coming in, your tenants paying their rents, through the operations of the building, so your internal expenditures associated with running that building, through your taxes, your debt service, which is your mortgage payment, right through to your free and clear cash flow, or in other words, your profit. That flow of cash is what's called cash flow. The second reason why real estate is attractive is the term called leverage and capital appreciation. Leverage, I'll give you the engineering definition of leverage. The engineering definition of leverage is the mechanical advantage to be able to move an object using a lever. Perfect example is your wheel wrench. The reason why you have a wheel wrench is because you have a mechanical advantage. Next time you have a moment, go up to your car and try to loosen your wheel bolts just using your bare hands. Good luck trying to do that. Now use the wheel wrench provided by the manufacturer of the car, and it's like cake. The reason for that, that's a glorified lever or a glorified crowbar. It's essentially a lever, and it's giving you that mechanical advantage. Likewise, with real estate, with the ability to use bank financing, you're able to purchase a piece of real estate, a piece of expensive real estate that you normally wouldn't be able to purchase with your own income, but you use the leverage of the bank. The next benefit to real estate is the tax benefits. I hear people saying all the time, number one thing that people say is, oh, my attorney or my accountant told me to purchase a piece of real estate. Well, why is that? Well, I need a tax write-off. Do you even understand what a tax write-off is? What does that mean? So we're going to get into actually how real estate affects your tax bracket and how on a Schedule E you can actually have write-offs. So we're going to get into, so to illustrate that, I am going to give you an example on cash flow. Cash flow, we're going to use an example of a property that has a total revenue of $67,000 in income. This is actually a real example of a property we manage. We have a vacancy loss of $2,700. Vacancy loss means the apartment was vacant, therefore we did not have any income being generated. What I call economic loss, that is the worst case scenario. You have a tenant actually occupying the space, but unfortunately is not paying your rent. So we have an economic loss. We have an adjusted gross income of $61,000. Adjusted gross income is what actually you were able to collect from this building. Going through the flow of cash, now you have operating expenses. The operating expenses are $24,700. The operating expenses, again, are the operations of the building, such as maintenance, such as common area utilities, such as landscaping. Again, the operational aspects of the building. You have a net operating income, which is the difference between what you've collected and what you've expensed out. That's your net operating income. Your mortgage payments are in the order of $20,203, giving you free and clear cash flow of $16,000. Again, folks, that's $16,000 free and clear cash flow that goes into your pocket. So that's one of the benefits. Leverage, just to give you an example of leverage. So we have a building that we've purchased for $360,000, and I'm actually going to show you the example of having $72,000 cash and having an option or a choice of investing in real estate versus investing in a stock or a CD. So again, we're purchasing a $360,000 building. We've got $72,000 of cash, corporate cash that you folks have saved in your savings account and you want to invest in real estate. So you've got a choice of either buying a piece of real estate or putting that money in a stock or a CD. Let's go through the stock or CD example first. So a fair assumption, let's just assume that both of these products, the real estate and the stock or CD, are going to both return a 10% return on value in year one. Again, that's a fair assumption. It may not appreciate, but we're equally distributing that appreciation across both products. So in year one with the stock or the CD, you take $72,000, you buy that stock is going to appreciate at the face value that you purchased it at. So in year one, you have a $7,200 return on that $72,000 investment. Your original investment, if you cashed out in year one, would be what you placed, your original sum of it money, which was $72,000, plus your return of $7,200. Your net year one cash out is $79,200. Now let's look at real estate. The power of leverage. You have a $72,000 that qualifies for 20% down for the purchase of a $360,000 piece of real estate, an apartment building. Now the beauty is the capital appreciation on that is not on the income or your down payment. It's not on the $72,000. It's on the entire value of the building. The power of leverage. Your building is going to appreciate at 10% of, again, the original price, which is $360,000. So your year one return is $36,000 of return. You add that to your original $72,000 investment, and now your year one cash out is $108,000. You see the difference and you see the power of leverage, $108,000 versus $79,200. But the true beauty comes with this. The true beauty of leverage is if it's a rental building, your leveraged position, again your leveraged position is $360,000, your leveraged position is being paid down by your tenants. The rents that you receive are being paid down by your tenants. So you're paying off your leveraged position with money that's not yours. And that's the true beauty of leverage. So to discuss tax benefits, one of the things that we want to look at is what really a tax benefit is. I always have my own staff says this to me all the time. Hey, Francis, could you pay for this race to run across the nation? And my question back to them is, do you even know what a tax write-off is? A tax write-off is written off of the income that you make. It's a reduction in your taxable position. So, for example, if I did pay for my employee to run across the nation and I paid $300 for that, it does not mean that I get a $300 check from the government. What it means is it reduces my taxable position on my income by $300. That's only if it qualifies. If it's a qualified business expense, I'm able to take that position, that expense, and write it off my income from a taxable position. So it's really not a check that I get back. In the world of real estate, your real estate income and your real estate expenses are recorded on what's called a Schedule E. Now, this is when your accountant tells you to go out and buy a piece of real estate, this is what he's talking about, is your Schedule E. We need to understand this, folks, so that when someone says, I need that tax write-off, you really need to understand where is that tax write-off and how is it really affecting your taxes. Your Schedule E, I would recommend that you go out and print out a Schedule E on Google. They're very easy to find. Just print it out and understand that and get intimate with that document. Essentially, what a Schedule E does is it reports your income. Every single rent that's received, your total income is recorded, but it gives you the ability to write off your expenses as well. But the true beauty is there's 2 additional write-offs that you can write off on your Schedule E, thanks to the IRS and thanks to the government. There's 2 additional write-offs that we can take. One is called depreciation, and the second is your mortgage interest. Again, these are all recorded on your Schedule E. So to go through an example, on my previous example when I showed you the cash flow and the leveraged position, we had a free and clear cash flow of $16,847. And to be clear on that number, folks, that $16,000 was real, true income. That was income or cash that went into your pocket. Because if you recall, all the operations of the building were paid, and your mortgage was paid, and that $16,000 is net, again, in your pocket. So you have a $16,000 cash flow that's recorded on your Schedule E. Now I'm going to show you the 2 factors that are able to reduce your taxable position. The building value, the depreciation factor is calculated like this. You can depreciate an actual physical building. You can't depreciate land because land doesn't depreciate. So the government gives you the opportunity to take a building. The value of the building is your purchase price, $360,000. You back off the land value. There is a predetermined land value. In this particular building that we're looking at, the land value was $60,000. So your depreciation or your building value is the 360 minus the 60,000. So you have a building value of $300,000. The government allows you to depreciate a building over 27.5 years. So in this particular example, we have 300,000 divided by 27.5 years, giving you a deduction of $10,000 a year, again reduced from your taxable position. So essentially, with the power of depreciation, you're taking that income and you're reducing it by $10,000. So your original income, I don't want you to get confused on this, your original income that you would have been taxed on is not the cash flow, but it's actually a higher amount called your net operating income. Your potential tax liability that you would have paid would have been $37,000, which was your net operating income, not really your cash flow. With the power of depreciation, your tax liability gets reduced by subtracting the $10,000 of depreciation. So with the power of depreciation, your taxable position becomes $26,141. But there's still one more tax write-off, and that's the mortgage interest deduction. That is in your mortgage payment, every mortgage payment that you make, there's a factor of principal that gets reduced, and there's a factor of interest that gets reduced. All those accrued interest payments, again, the government allows you to reduce that. So now you take your $26,000, which was after you reduced your depreciation, $26,000, you reduce that by your mortgage interest, which in this case was $14,265, and you're paying taxes on $11,876. So the power of depreciation and the tax benefit is you realized $16,000 worth of cash that went into your pocket, but you're paying taxes on $11,876. So you have $4,000 of a reduction in what your taxable position is. So again, just to sum up, part 2 is why we want to invest in real estate. So the 3 reasons that I covered today was cash flow, the power of cash flow, the power of leverage and capital appreciation, and also the tax benefits associated with real estate. There is one more advantage to real estate, especially in the market today. I'm not going to get into a whole lot of depth in this, but it is called the demographic changes that's going on in society today. Over the last couple of years, with the changes in the market, the demographics are changing. People's intentions and long-term wants to own a home are changing, and we're becoming a nation of renters. This is a whole separate topic that I'm not going to cover because it's not the scope of today's discussion, but there is that fourth tangible reason why real estate is great, and it's going to be great for the next 10 to 15 to 20 years, who knows how long, but this is a long-term cultural shift in the way people are looking at housing and investing these days. The younger generation is not like the older generation. They want that flexibility to be able to move, and renting is becoming, you know, a thing of the future. So we are becoming a nation of renters, and that's going to be definitely one of the things to focus and look into.